Weak global cues hit Indian markets. The Nifty slips below the 18,000 mark for the first time since the November 10th. All sectors apart from pharma and healthcare correct as COVID and recession fears weigh.
The broader market considerably underperforms key indices. Mid-cap index loses over 2% as advanced decline ratio spikes to 10 shares, losing out for every one in the green.
City Union Bank continues to correct after it reported a GNPA divergence of 259 crore rupees. Earlier this morning, the management joined us here and said that 65 crore rupees were likely to be recognized as bad assets on that one. Also hints at higher recoveries from old non-performing assets.
Ingersoll Rand surges after announcing capacity expansion plans to the tune of 170 crore rupees. The new plant will be set up in Gujarat.
Weak debut for amidst weak markets for Landmark Cars as well as Abans Holdings. Both of them see cuts of nearly 9 to 15% on listing.
Good morning. Welcome to Chartbusters on CNBC-TV18. I'm Sonal Bhutra and with me is Mangala Malu. Well, Mangala, most of us have got the color right today and that is something that was expected as well. Weak global cues and that is something that is weighing on our own markets as well. Nifty below that 18,000 mark for the first time since 10th of November. A mild recovery is what we are seeing, but still it's a big cut across the board. The mid-cap index too is the one continues to underperform and today as well it's seeing a cut of 2%.
Yes, it is. And color of Christmas is both red and green as well as white. So if the markets are not doing anything, you're wearing white. If they're going lower, it's red. And if they're going up, it's green. So market has Christmas 365 days a year. But as we speak right now, there is firm weakness. No taking away from that. The advanced decline ratio is the one that really is hurting right now. 11 stocks in the red for one in the green. And it's only getting worse by the day. So this week so far, we have the mid-cap index, which has underperformed the broader markets, underperformed the frontline indices by a factor of 2. So the mid-cap index currently is lower by almost 4% this week, whereas the Nifty itself is down by about 2%. But let's talk about a bunch of stocks which are in focus. We have the premium automobile dealer Landmark Cars, a weak debut on the exchanges, listing with an 8% discount to its issue price, sitting with a cut of about 9% right now from the issue price as well. Mr. Thakkar, who's the chairman of the company, joins us to tell us more about the plans for the business post-listing. Thanks a lot, Mr. Thakkar, for joining. And now that you've listed, everyone will be eyeing what you do in the business a lot more. Just from a business standpoint, just wanted to understand what is more accretive for you, selling new cars or selling after-sales cars? Is that more return accretive? Your current ratio is 80-20. Where does this go going forward?
Yeah, so we do a very interesting kind of business.
Yeah, go ahead.
The after-sales business for us is something which keeps on going on and on. It's like an annuity type of a business. So as many cars as we put on the road, they will give us income for the next 6-7 years. Last year, for example, we serviced close to 280,000 cars, which includes the accident repair ones also, and generated around 107 crores of EBITDA over there. And if you kind of go back last several years, this has been growing at a pace of 20% or more year on year. So this is something which is a 40% gross profit, 18% EBITDA margin business. 1 in 3 cars that you see on the road meets with an accident every single year. We'll get maybe 65,000 accident repair jobs this year. Now, this is something which is a high margin, predictable business. Nobody goes outside of the authorized dealerships in premium and luxury cars. So this is a predictable business. We make a good amount of money in car sales also because the car sales, the margins also include the insurance and the finance commission. So when we have the tailwinds behind us, we have a complete bouquet of things that are going for us, like the time we are in right now.
Okay, all right. Mr. Thakkar, good morning. I wanted to understand now that you're saying you're making decent margins in the new vehicle sales as well. You have around 5 brands in your kitty right now, the biggest one being Mercedes. There's Volkswagen, Jeep, Honda, Renault as well. Are you looking at tying up with any other new brands? Are those discussions in place? And this 80-20 split, do you expect it to change in next 2 to 3 years?
So you missed out BYD. So we
Yes.
have also signed up with the largest EV manufacturer in the world, which is the BYD. And what you will see from January, as soon as January, is the deliveries of the Atto 3, which is the nice fully electric car with 500 kilometers range. We are kind of sold out for rest of the year from what I believe. So the deliveries of that, those BYD cars will also start. Landmark will always remain in the premium and the luxury segment, which is the fastest growing segment that we all know. And so our sweet spot is vehicles above maybe 10 lakhs or so. And this is where the margins are, this is where the growth is, and this is where Landmark will be.
Okay.
30% of what we have done so far is by way of M&A. So, I'm sure a lot of other doors will open up and we will go to geographies and brands that we haven't yet represented.
No, I was going to ask you about BYD, but since that's the EV side of things, I wanted to ask specifically what's happening here, because you're talking about signing a letter of intent with BYD, which is a leading player in the global EV market as well. When you're saying it'll start, you'll start deliveries from January, what kind of kitty are you seeing here? What is the opportunity size?
So we have been already selling the BYD vehicles, which was the E6, which was earlier mainly for the leasing companies and the commercial segment. But the passenger car segment is what we will start delivering from January. We have been we are dealers for BYD in the large markets of Delhi and Mumbai. So that's what we are going to be doing, and God willing, things will do well.
All right. You said that, after sales is a 40% gross margin business. Can you give us a sense of your margin breakup across all the services that you offer? You have new vehicles that you sell. That's the mainstay of your business. Then there is after sales, which is annuity. What kind of margins do you get there? Sales of pre-owned passenger vehicles. What is that as a proportion of your sales? What margins do you get there? And then you also, like you said, get margins from, financial and insurance products. So what is the kind of margin breakup across the value chain? Can you give us a sense?
Yeah, I'll give you a broad thing, the way it is. Let's first talk about the after-sales business. So in the after-sales business, we do two things. One is we sell spare parts and accessories, and the other is where we sell our services, which is what we call the labor addition to a service bill. So as far as the spare parts is concerned, the margins are in the region of around 20% to 25%, depending on what brand, what spare parts that you are selling. And as far as the labor component is concerned, we have a margin of around 80% on that. So this as a blended thing comes at around 40% or so. Also, what is important to note is that there are we need a critical car park where the business becomes extremely profitable for after sales going ahead. So brands like Jeep, I'll just point out a very simple thing. We started only in 2017 and 18. So those brands where we will have a critical mass of vehicles now on road, the business will become significantly profitable going ahead, which is right now a kind of a flattish. I'm talking about a single brand. So this is something which is very important. As far as the other margins are concerned, Mercedes-Benz has now gone into a very nice asset-light model where we do not hold inventory in our books. And whatever we sell, we get a clean margin. There is no discount, all India, one price. So Mercedes-Benz, we get a clean 5 to 6% margin at the end of the month that we sell the car. Okay. We make, as far as the group is concerned, one can see that approximately just under 1% of what we sell, we make by way of finance and insurance. So this is again a very simple, predictable business that we run. So to look at the business, we have a after sales business which is growing at around 20% CAGR for so many years, and which will continue to grow at 40% margin, a gross margin, 18% EBITDA margin. Then on top of it, you have the finance and insurance clean straight income of new car sales, and then there is that new car margin. Now, if you add it all up, it becomes a great scoop at around 6.5% EBITDA and 2.5 to 3% net margin business.
That was actually going to be my next question. What kind of blended margins are you looking at? At FY22, it was 5.9%, expecting 6.2% to 6.3% going forward.
Yeah, I think that's what will happen already. I think it is happening, and I'm sure the better times are ahead of us.
Just quickly, before we let you go, what currently is your market share in the brands that you have? I mean, there are non-exclusive contracts that you have as well. And what are the chances of you, increasing your market share there, increasing your geographical presence? You said you are looking at inorganic growth.
Significant possibilities. So we are the largest partners for Mercedes-Benz. 1 in 6 Mercedes sold in India is by Landmark, and we have gradually increased our market share year on year. We are the largest partners for Honda. We are the largest partners for Jeep, around 27% market share. Our Volkswagen market share is now touching close to 10% in India, where the volumes are growing. BYD, it's early days, but my sense is that we will be between 15 and 20% of their all India sales for BYD going ahead. And I mean, we become the meaningful player. I mean, the way Landmark is that we are the meaningful player for everybody that we partner with. And we have a seat at the discussion table. And yeah.
Yes. All right, Mr. Thakkar, it was a pleasure speaking with you. Thank you so much for joining us and detailing your business prospects and details as well there. Thank you so much for joining us today. Well, that's Landmark. New listing down around 8.5% today. But for now, we'll sip into a short break. Up next, Dharmesh Shah of ICICI Direct will join in to discuss the technicals of the market. Stay tuned.
Market continues to weaken. We have the Nifty down almost 190 odd points. The mid-cap index is where the weakness is. So let's get chatting with Dharmesh Shah for a quick view on the market's charts. Dharmesh, your thoughts on the indices and individual stocks. What do you have for us today?
Yeah. So good morning, Mangla. Yes, definitely I think the market, the sentiment remains to be very weak. We have the third week of lower top, lower bottom formation. But one thing we have observed is that if you look at the market has seen a 9 weeks of rallies from 16,800 to 18,900. And what we see is more of a corrective phase of this rally. Because if you go back to the July rallies of 15,800 to 15,500 to around 17,000, it took 9 weeks of rallies and almost 3 weeks of corrective phase. In this 3 weeks of corrective phase, the market has corrected 7%. What we feel in the current context is that we have already seen a 9 weeks exactly rally and a third week of corrective phase. So price-wise as well as time-wise, maybe we may be settling around 17,600 to 800 as a strong support for the Nifty, which we don't expect to breach. So maybe I think so 1 or 2 day market is entering into the oversold territory. So by next week, we are expecting a technical pullback towards 18,300 to 400 on the Nifty. So I think so the current levels going short could be a bit of a risky. Strong support at 17,600 to 17,800 is likely to see hold, and we will see a technical pullback in the coming.
Okay, all right, Dharmesh, thank you so much for joining us. Well, that is the technical outlook as far as indices are concerned. For now, we'll sip into a break. We'll be joined by the management of Radiant Cash Management Systems as their IPO opens today. Stay tuned. Welcome back. Still tuned into Chartbusters. Integrated cash logistics player Radiant Cash Management's 387 crore rupee IPO has opened for subscription today. Colonel David Devasahayam, who is the chairman and managing director at the company, is joining us now to discuss the prospects of the business and the outlook going forward as well. Mr. Devasahayam, good morning. Thanks a lot for joining us. Well, it's time to talk business because you have seen a revenue growth of 29% in terms of your revenues, which is higher than the industry growth of 20%. Is this number sustainable for you? What is the outlook going forward? And your margins in Q1 increased by 500 basis points. Before that, you were doing margins close to the 24-25% mark. What led to this jump, and is this number sustainable as well?
Well, good morning, and thank you for having me this morning. Firstly, I'd like to say I'm a little different kind of entrepreneur. I was 25 years in the army, and having commanded 2 battalions and a training center. And 21% of our workforce is from the armed forces, ex-armed forces, the officers and men who serve with us. So that brings in a lot of commitment, dedication, and discipline, integrity, and also frugality. And that's one of the reasons we have the best ROE and ROC numbers in the industry. Now, coming on to your specific question of the first quarter, the first quarter is indicative of the future. Last 2 years were COVID impacted. And the current EBITDA margins that we are resting with 84 crores of revenue and 25.5% of EBITDA and over 18% of PAT. That is clearly the future. I can indicate, our growth is driven by the number of pickup points that we have. So at the time of filing the DRHP, we were at 42,000 points. From that, today we have grown to 55,000 points, 13,000 points. That means 1,100 points per month. That's been our growth rate. So I think that bodes well for the future.
Right, Colonel, and thanks a lot for your endeavors towards the armed forces, your services. The nation thanks you, and also thanks you for employing ex-armed forces for your business as well. So to that, we will obviously be extremely happy about. But as far as the business itself is concerned, just wanted to understand, why is it that you need so much working capital? I mean, I'm looking at your competitors' working capital days. CMS Info has 60 days, SIS around 24 days. You have well over 150 odd days. Why is that? And why you, so stretched on working capital?
I don't think there's any stress on working capital as of now. And that will be clearly indicated by the interest that we've been paying as far as our CC accounts are concerned. And we have, as I speak, approximately about 40 crores surplus on our books that we have. We go about it in a very deliberate manner. It is 150 is wrong. It's about 85 to 90 days. That's where we are. I believe in that, and therefore we have zero bad debt.
Okay.
Firstly, given, say, a 30-day cycle, after 30 days of working, we raise a draft invoice 9 days thereafter.
Okay.
And we send it back to all our clients, ask them to check on it. And they come back to us after about 8 to 9 days. And once that is cleared by them, only thereafter we raise the bills. And I'd like to say that though you have said this, we have given the upper number. Almost 60 to 70% of our clients are, the receivable is within 45 to 50 days.
Okay, we get that point. Last question before we let you go. I wanted to understand that you have mentioned buying specially fabricated armored vans. This is something that you've written in the DRHP. Right now, largely you are leasing vans. Why do you want to move from this asset-light model, and what kind of investment will you make in buying these armored vans, that is?
Yes, you're right. It's a shift from my existing policy. We felt that strategically in our board when we discussed that at least there should be 20 to 25% of the inventory should be physically held by us. And this is because, we are based on leasing and we have remained extremely asset light. But to immediately respond to new opportunities that come, large numbers of, cash vans being suddenly required. Secondly, thanks to regulatory pressure, now, large number of, we have been reduced to, it's a very consolidated industry, and new opportunities in the cash and transit space are opening up. And so that was a conscious decision as a board that for the first time we are holding a strong inventory of over 200 vehicles on our books.
All right, Colonel, we will, speak more with you as the days progress, as you list, and then you'll have the liberty to also talk a lot more about the future outlook of your business. For now, we just wish you good luck for the IPO. Thank you. That was... Okay, with that, we will wrap up on this edition of Chartbusters. You stay tuned to CNBC-TV18. The market continues to be weak. It will be covered by the team of Trading Hour just after this break.